Imagine waking up one morning, checking your investment account, and seeing that the stock market has dropped 20%. Your first instinct might be to panic, sell everything, and promise yourself never to invest again. But here's something fascinating. History shows that the people who become wealthy through investing usually do the exact opposite. So what do they understand that most beginners don't? The answer lies in the science behind long-term investing. When most people think about investing, they imagine picking the perfect stock or predicting the next market boom. In reality, successful investing is less about intelligence and more about psychology. That's why learning how to invest in stocks as a beginner starts with understanding your own mind before understanding the market. Our brains evolved to survive immediate dangers, not to build wealth over decades. When stock prices fall, your brain treats it like a threat. Stress hormones rise, fear takes over, and suddenly selling feels like the safest option. Yet the stock market has repeatedly rewarded those who stay patient through uncertainty. That's one of the biggest lessons in investment psychology. Think about planting a mango tree. You wouldn't dig it up every week to check if the roots are growing. You water it, protect it, and trust the process. Long-term investing works much the same way. Every contribution you make, every dividend you reinvest, and every year you stay invested allows the power of compound interest to quietly do its job. Take two friends as an example. One spends years chasing the latest trending stocks, buying high and selling low whenever fear takes over. The other invests consistently in quality businesses or diversified index funds, regardless of market headlines. 20 years later, the second investor often comes out far ahead, not because they were smarter, but because they stayed disciplined. Research in behavioral finance consistently shows that emotions, not lack of knowledge, are responsible for many investing mistakes. Fear causes people to sell during market crashes, while greed encourages them to buy after prices have already soared. The market doesn't just test your financial knowledge, it tests your emotional discipline. If you're wondering how to invest in stocks as a beginner, start with simple habits. Invest money you won't need in the near future. Diversify instead of betting everything on one company. Invest consistently, even when the headlines are negative. And most importantly, give your investments time to grow. Wealth building is usually the result of thousands of small, smart decisions repeated over many years. Financial freedom rarely comes from chasing shortcuts. It comes from patience, consistency, and trusting a proven process. The science behind long-term investing isn't complicated. It's simply difficult because it asks us to stay calm when everyone else is reacting emotionally. So the next time the market feels uncertain, remember that temporary volatility has always been part of the journey. Stay focused on your long-term goals, keep learning, and let time become your greatest investing partner. If you found this helpful, subscribe for more videos on how to invest in stocks as a beginner, stock market investing, and investment psychology. And let me know in the comments, what's the biggest challenge you face when trying to stay invested for the long term? Until next time, keep investing in your future, one smart decision at a time.